Qualcomm dropped 0.5%. Lab scores at 50 out of 100. Hold. Two pillars: Snapdragon X Elite PC integration and a multi-year AI upgrade cycle anchor the upside and drive future growth. The lab's 50-point rating captures the neutral stance despite AI hype. Our full teardown shows why the AI engine won't lift the stock today. Qualcomm is currently the focal point of the semiconductor sector not because of its consumer mobile dominance, but because it is being dragged into a magic formula debate by retirees while the market struggles to reconcile its identity. With the stock trading at $188.49, investors are caught between the narrative of a value play turnaround and the reality of a company struggling to maintain its performance premium. The market is pricing in extreme fear, reflected by a sentiment score of 12, as capital rotates out of legacy mobile-dependent revenue and toward high-growth compute infrastructure. While the broader indices remain flat, Qualcomm's 0.5% dip highlights a persistent underperformance, trailing the XLK Technology Sector Index by 17.5% over the last 30 days. Investors are reacting to a series of mixed signals: a beat-and-raise earnings streak that has failed to ignite a sustained rally, and persistent rumors of potential acquisitions designed to force a pivot into AI. The market is essentially waiting for proof that Qualcomm can transition from a smartphone modem company to an AI compute power player before it commits fresh capital. The engineering reality behind this valuation is defined by the thermal and bandwidth constraints of the Snapdragon X Elite AI engine. The current bottleneck is not the compute throughput, but the memory wall, the physical limit on how fast data can move between the NPU and the LPDDR5X memory. Qualcomm is currently pushing a 4nm chip-on-wafer package, a method of stacking silicon dies vertically to reduce interconnect latency, but they are hitting a hard thermal density limit. Compared to the Blackwell architecture from NVIDIA, which utilizes a massive 104 billion transistor count and high-bandwidth memory to manage thermal load across a larger die, Qualcomm's mobile-first silicon struggles to sustain high-wattage operations without significant throttling. Their current yield on these advanced packaging nodes is a critical variable. If they cannot maintain high wafer throughput while managing the defect density of these complex 3D stacks, their margins will continue to compress. The market is betting that Qualcomm can scale this architecture to compete with custom ASIC designs, but the physics of mobile power envelopes, typically capped under 15 watts for sustained peak load, severely limits their competitive ceiling against dedicated server-side silicon. Qualcomm is essentially trying to port a server-class AI workload into a mobile-class power budget. Our engineering assessment confirms the market skepticism. The transition to a high-performance AI player is physically constrained by their current reliance on mobile-optimized thermal and power management architectures. Quarterly financials showing modest revenue momentum for Qualcomm. By Q1 2027, the intersection of aggressive U.S. export controls and the cyclical nature of the smartphone replacement market will drive a valuation multiple contraction for Qualcomm, likely forcing the stock to retest its $184 support level as margin pressure intensifies. The macro environment is currently a friction force, not a tailwind. With the Fed holding rates at 3.63% and CPI lingering at 0.6% year-over-year, the cost of capital for R&D heavy semiconductor firms remains elevated. The yield curve is normalizing, but the 8.9% recession risk signal from prediction markets suggests that institutional capital is bracing for a slowdown in consumer discretionary spending. Qualcomm's revenue growth of -3.5% confirms that the current monetary environment is suppressing the high-end smartphone refresh cycle that the company relies on to fund its next-gen AI roadmap. Policy is the primary friction point. The U.S. export control rule that caps radio frequency front-end modules above 6 GHz is not just a headline. It is a direct hit to the bottom line. This regulation forces a costly redesign of the Snapdragon X 75G modem for Chinese OEMs, which accounts for a significant, albeit undisclosed, percentage of revenue. Management's recent earnings remarks glossed over the specific margin impact of these redesigns, focusing instead on long-term AI growth. However, The CHIPS Act's $52 billion in potential incentives provides a theoretical floor for domestic production, yet the capital expenditure required to ramp a 7nm line in Arizona will weigh on free cash flow for years. The market is rotating away from companies with high China exposure, and Qualcomm is currently caught in the crosshairs of this policy-driven capital flight. Geopolitically, the Taiwan Strait risk is the single largest threat to the company's supply chain. While TSMC's May revenue growth of 30.1% year-over-year indicates that the broader AI supply chain is accelerating, Qualcomm's inability to capture that growth as effectively as pure-play AI infrastructure firms suggests a structural misalignment. The US-China tech war is not merely academic. It is a direct disruption to the semiconductor ecosystem. Qualcomm's exposure to the Asia-Pacific market, specifically the Chinese handset market, leaves it highly vulnerable to retaliatory sanctions. If tensions escalate over Greenland or other flashpoints, the supply chain nodes, specifically the packaging and testing facilities in the region, could face immediate bottlenecks, causing a catastrophic spike in cost of goods sold. Socially, the narrative is shifting against big tech's AI dominance. There is a growing public policy sentiment favoring stricter AI regulation and antitrust scrutiny, which threatens the software-hardware integration modes that Qualcomm is trying to build. Labor cost dynamics are also shifting, as the engineering talent required to design these complex 4nm AI engines has become significantly more expensive, further pressuring operating margins. While the company attempts to frame itself as an AI-first firm, the reality is that its revenue is still heavily tied to consumer smartphone cycles, which are currently being dampened by both high interest rates and geopolitical uncertainty. The macro wave is pulling against Qualcomm. The company is fighting to maintain its margin profile, while the cost of defending its market share in the mobile space continues to rise. The earnings report failed to provide a concrete plan to decouple from these macro headwinds, leaving the stock vulnerable to further downside as the market reprices the risk of a prolonged trade war and a cooling consumer electronics sector. Qualcomm reported earnings per share of $2.65, beating the Wall Street estimate of $2.61 by 1.4%. A solid beat that signals strong execution. Qualcomm is trading below its 20-day average, currently at 188. Results of operations and financial condition is the exact clinical phrase Qualcomm's management led with in their official disclosures. This dry, regulatory language is designed to project absolute stability. It masks the frantic noise of their marketing pivot. The corporate machinery wants you focused on the glossy narrative of a smartphone chipmaker remaking itself into an AI, artificial intelligence, the simulation of human intelligence by machines, pioneer. They want you talking about the Dragonfly C1000 CPU, central processing unit, the primary component of a computer that performs most processing, designed for agentic AI workloads. They want you celebrating the bold target of $40 billion in non-handset revenue by fiscal 2029. This framing is engineered to make investors feel that Qualcomm has escaped the cyclical gravity of the mobile phone market. It is designed to make you ignore the slowing consumer upgrade cycle. But while the public relations team sells the future, the insiders are selling the stock. We tracked $5,778,958 of net insider selling over the past 90 days. CEO Cristiano R. Amon personally executed two separate sales of $1,850,000 and $1,800,000. This pattern of C-suite liquidation historically precedes periods of growth normalization. It signals that those with the clearest view of the order book are locking in cash. 2% upward bump in stock price is likely driven by retail momentum following positive analyst commentary. Mizuho, for instance, raised its price target to $210 from $170. The crowd on social media remains 100% bullish, dreaming of a massive pump back to $190. This retail optimism ignores the structural friction of the underlying hardware business. What management is saying is that their AI transformation is an unmitigated success. What the lab hears is a mature hardware giant whose own leadership is quietly taking money off the table. The financial spine of this business reveals a deeper divergence. Qualcomm delivered an EPS, earnings per share, the portion of a company's profit allocated to each outstanding share of common stock, beat of 1.4%, posting $2.65 against the $2.61 estimate. This marks a four-quarter beat streak with an average surprise of 1.1%. This looks stable on the surface, but look at the innovation engine. Qualcomm's R&D, research and development, the activities companies undertake to innovate and introduce new products. Efficiency stands at $9 billion, which is 20.4% of revenue. That is a year-over-year increase of only 1.7%. This minimal R&D expansion indicates that the AI pivot is largely a marketing rebrand of existing silicon architectures rather than an aggressive, capital-intensive engineering overhaul. No qualifying executive statement in the last 6 months is available in the transcripts to verify their verbal pivots, but the written SEC, Securities and Exchange Commission, the federal agency regulating securities markets, filings tell the real story. In their latest 10Q quarterly financial report filed with the SEC, the word manufacturer appears 81 times, while data center appears only 10 times. This massive statistical gap reveals the friction. Despite the glossy PR targeting $15 billion in data center revenue, the operational reality remains bound to physical manufacturing bottlenecks and traditional supply chains. Wall Street positioning shows that institutional funds like Van Eck Associates Corporation added 35% to their holdings. However, these backward-looking 13F quarterly report filed by institutional investment managers to disclose their equity holdings. Filings reflect historical positioning, not the current post-Investor Day reality. Furthermore, short seller volume remains stable at 29.6% of daily volume, indicating that professional bears are not yet crowding the exit. Watch for R&D as a percentage of revenue to drop below 20% in the next 10Q. If that spending contracts while insider selling continues, the structural bull thesis is broken. The momentum breakdown for Qualcomm. RSI sits at 38, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for Qualcomm rests on two pillars: the successful integration of the Snapdragon X Elite AI engine into the PC market and the potential for a massive, multi-year upgrade cycle driven by on-device AI. If Qualcomm captures even a fraction of the laptop market from legacy x86 architectures, the revenue diversification would be transformative. Furthermore, their P/E of 17.2x forward earnings is arguably cheap compared to the broader semiconductor sector, suggesting that much of the geopolitical risk is already baked into the current price. But the bear case is far more grounded in engineering reality. The primary risk is the mobile-first thermal wall. Qualcomm's architecture is optimized for low-power mobile devices, not the sustained, high-wattage workloads required for enterprise AI. When you look at the recent analyst actions, the divergence is telling. Mizuho and Citi maintain a neutral stance despite price target hikes, while Barclays remains underweight. This suggests that even the sell side is hesitant to buy into the AI pivot narrative. The 13F filings from the show institutional accumulation by firms like BlackRock, but this is slow-moving capital that does not reflect the current high-fear sentiment. The bear thesis is that Qualcomm is trying to solve a server-grade problem with a phone-grade tool, and the physics of heat dissipation will ultimately force a lower-margin, commodity-tier outcome in the AI accelerator space. The question that makes the room go quiet is this: how does Qualcomm plan to maintain its 4nm packaging yields while scaling to the HBM3E bandwidth requirements of next-gen AI without a drastic increase in TDP? The lab's answer is that they likely cannot without a fundamental shift in their interconnect architecture, which they have yet to prove at scale. Our verdict is clear. If Qualcomm manages to ship their next-gen AI engine in a 4nm chip-on-wafer package by the end of 2026, the stock could retest the $249 resistance level on the back of renewed institutional confidence. However, if the current export control redesigns continue to delay shipments to Tier 1 Chinese OEMs, the stock is likely to break the $184 support level and drift toward the $160 range. Given the current RSI of 38.7 and bearish MACD momentum, the path of least resistance is lower. The AI score of 50-100 reflects this fundamental uncertainty. We are watching the $188.49 support level closely. A clean break below this on high volume confirms the bear case. Here's the macro picture shaping Qualcomm. The U.S. export control rule that caps RF front-end modules above 6 GHz forces Qualcomm to redesign its Snapdragon X75G modem for Chinese OEMs, pushing back shipments to Huawei and other Tier 1 carriers. At the same time, the CHIPS Act's $52 billion fab incentive helps Qualcomm start a 7nm line in Arizona, yet the U.S. China tech war and Taiwan Strait risk keep its supply chain exposure elevated. The industry's shift toward integrated AI accelerators and heterogeneous 3D packaging is now the core growth engine for Qualcomm, exemplified by the Snapdragon X Elite AI engine and its CoWoS-based 5G AI SoC that bundles LPDDR5X and HBM2E memory. Looking ahead, Qualcomm's roadmap to embed its next-gen AI engine in a 4nm chip-on-wafer package by 2025 will push performance per. Qualcomm is getting lapped on the only metric that matters right now, revenue growth, and the numbers don't lie. Let's start with Broadcom. Broadcom is printing 47.9% revenue growth, while Qualcomm shrinks 3.5%. That's not a gap, that's a chasm. Broadcom's AI networking chips are the backbone of every hyperscaler build-out, and their custom silicon deals with Meta and Google are locking in multi-year backlogs. Qualcomm's Snapdragon X Elite is a shiny press release. Broadcom's Tomahawk 5 is already shipping in volume. Edge, Broadcom, no contest. Next, AMD. They're growing at 37.8%, nearly 40 points ahead of Qualcomm, and their gross margin is 53%. Not as lush as Qualcomm's implied 70% plus, but still healthy. The kicker? AMD's MI300X is the only GPU that can challenge NVIDIA's H100 in AI training, and they're ramping supply faster than anyone expected. Qualcomm's AI PC push is a side bet. AMD's data center business is the main event. Edge, AMD, and it's widening. Marvel's the quiet killer here. 27.6% revenue growth, 52% gross margin, and their custom ASICs for AI and 5G infrastructure are embedded in every major cloud and telecom rollout. Qualcomm's modem business is a cash cow, but it's mature. Marvel's optical interconnects and DPUs are the picks and shovels of the AI gold rush. Edge, MRVL, and they're doing it with half the fanfare. Now, valuation. Qualcomm's P/E is not applicable because earnings are evaporating. Broadcom trades at 61.4x, but that's justified by 48% growth and 76% gross margins. AMD's 167.9x P/E looks insane until you realize their revenue growth is 10x Qualcomm's. Marvel's 88.3x is rich, but their backlog is growing at 50% plus annually. Qualcomm's multiple isn't just missing, it's irrelevant. The market isn't pricing in a turnaround, it's pricing in irrelevance. Capital efficiency? Broadcom's 76% gross margin on 48% growth is the gold standard. AMD's 53% margin on 38% growth is the best risk-reward in semis right now. Marvel's 52% margin on 28% growth is underrated. Qualcomm's margins are a mirage, high today, but shrinking revenue means fixed costs are eating them alive. The math doesn't work. Here's the verdict. Qualcomm stock is a value trap dressed as a turnaround story. The AI PC narrative is a distraction. The real action is in data center, networking, and custom silicon, where Qualcomm has no edge. If you want exposure to the AI and semiconductor boom, Broadcom, AMD, and Marvel are all better horses at better prices. Qualcomm's time in the sun is over until they prove they can grow again. Don't bet on hope, bet on the numbers. QCOM's 4nm Snapdragon die yields just hit 92%, but that's not the win Wall Street thinks. Is the bull case or bear case stronger for Qualcomm? Drop your thesis in the comments. This isn't financial advice, just our take. Markets move fast, and past performance never guarantees future results. Always do your own research before trading. We're here to break down the engineering, not tell you what to buy. Subscribe to catch the next deep dive. We're tracking every wafer start. If you want our full breakdown on Rocket Lab, the link is in the description. Stay sharp, engineers.